The first way, I think, to understand Bitcoin is to understand the history of money and the role of money. Anthropologists say that there's no evidence of any tribe, much less a civilization, that ever used barter for trade. And that should be quite counterintuitive to most of us, because we are taught in school that we first bartered, and then we invented money because bartering was too hard. Well, that's not true. That never happened. From about 100,000 years ago to about 25,000 years ago, the way we did trade was that everybody in our tribe would know that you killed a big buffalo, and I would come up to you and say, hey, you're not going to eat that whole buffalo. Can I have a little bit of meat? And you would decide whether you want to give me some meat or not. And other members from the tribe would come and ask you for some meat, and you would decide who do you give meat to and who you don't give meat to. And you have to remember who you gave meat to, and because you hope that they will pay you back somehow, sometime in the future. It's a very subjective system, but that's how trade worked. We all walked around with these subjective ledgers in our minds of who owes us what. And hopefully those people eventually repaid us, and hopefully they repaid us in something that felt fair to us. It was never going to be, usually not in the same way we paid them. It's an incredibly subjective system, but we used it for a very, very long time, for 75,000 years at least, longer than any other system. Until someone very intelligent in our tribe came up with a new technology, an innovation, and said, you know what, Wences, can I have a little bit of your firewood? Everybody knows that you have a lot of firewood. And I said, sure, here's your firewood. And this time, this person said, you know, we're going to try a new technology, a new innovation. Here's some beads for you. And I said, no, I don't need beads, thank you. And said, no, this is not about whether you want or need beads. We're going to use beads to keep track of our debt. So we don't have to remember them subjectively anymore. You just keep the beads, and that will be how much you are owed. And it was such a successful technology that it just took off. And very quickly, in a couple thousand years, it's impossible to find some tribe or some civilization that doesn't have some form of ledger, objective ledger. Some tribes chose salt, some others chose rocks, seashell, different forms of ways to keep track of debts in their society and their tribe. Anthropologists go as far as saying that if you describe to them the environment of a tribe, they can easily predict what's going to emerge as a ledger in that tribe, because it's always something that the most important quality that object has is that it's scarce. It makes sense, because if something that we are going to use to keep track of debts, if it's not scarce, if we use tree leaves, I can simply pick leaves from a tree and create fake debt to benefit myself at the expense of everybody else. So scarcity is the most important attribute of these things to keep track of debts. But also, there are 5 other attributes that are very important. One, that they are durable, that they don't decay or corrode, etc., that they be transportable, that they be divisible, recognizable, and fungible. This system took off and worked really, really well for about 20,000 years, from about 25,000 years ago to about 5,000 years ago. And 5,000 years ago, what happened is that tribes began to trade with other tribes, and they needed something in common. We had beads, you had seashells, and we couldn't trade. And what happened then is that gold emerged as not the universal ledger for one tribe, but the first universal ledger. And it was gold because it was something that was universally scarce. But it was also transportable, durable, divisible, recognizable, and fungible. This very short and high-level history of money, I want to illustrate 3 myths that if you believe in any of these 3 myths, it's really, really hard to understand the proper function of money and why Bitcoin matters. The first myth is that money was born out of barter, when actually it was born out of a need to keep track of debts. The second myth, and perhaps the biggest myth, is that money is backed by something. And when actually money has never been and will never be backed by anything, it's just a ledger. And people say, well, but the dollar used to be backed by something. Right now it's not backed by anything, but it used to be backed by gold. But in truth, that implies that gold is backed by something or has some intrinsic value. And the truth is, gold does not have any intrinsic value beyond being a great ledger. beyond being very scarce. We use it for jewelry because it's very scarce, because it represents wealth and power, but not because it's pretty. And this is a very common misunderstanding about money, that it's just a ledger, it's not backed by anything. And the final one is that money exists because it's created by government and because it's sponsored by government. And the truth is that money has been around for a lot longer than governments have been around, and it will be around as long as there are social interactions around. It fulfills a very basic social need. From where we are standing today, it's hard to understand the importance of gold, because right now the universal ledger is not gold, it's the US dollar. And before that, for about 500 years, we have had these reserve currencies. First the Portuguese escudo, then the Spanish, then the French, then the Dutch, then the British pound, and now the dollar. All of them have been the universal ledger, the reserve currencies, for about 100 years. But none of them have been anywhere near as good as keeping value as gold has. You know, if you had $100 in the 1800s and you saved it as $100, it was quite a lot of money. It may be more than a person's yearly income back then, and today you would have just $100. If you had put that in gold, you would have the same value of roughly more than a person's yearly income today. And we know of nothing else that is so good at keeping value other than gold. It's quite incredible that the best ledger we have ever found is such a primitive thing that takes billions of dollars to dig it out of the ground, and then we lock it in vaults underground again. It's incredible that with all the technology that we have today, that's the only one ledger that we can all use where we are not trusting a person, we're not trusting a bank or a company or a government, we're just trusting that it's something really scarce.
Money is, all it is a trade of your time. We actually don't want more money. We want more time. The money is a placeholder for what we think it will buy us in the future. It'll buy us more time, more vacation, more, like, retire with safety. So if you arbitrarily, with a keystroke, distort money, you distort our time. You destroy our time.
To me, Bitcoin has two kind of key mechanisms through which it can help us. Number one, it's a sovereign savings account. It's debasement proof, meaning the government cannot print more whenever they want. This is very, very different from fiat currency, which by its very name, its very nature, can be issued on sort of demand, right, by the rulers. And while I live in a country where the rulers do a reasonable job of managing the money, most people aren't so lucky. So only 13% of humans in the world live in a country that's a liberal democracy with property rights and has what we call a reserve currency, meaning a currency so stable and desirable that other countries save in it at the central bank level, right? You basically have the US, the UK, Australia, Switzerland, the euro, and Canada. I mean, those are like reserve currencies. And these are liberal democracies where people have reasonable guarantees over property rights. Everybody else either lives under like a weaker currency or an authoritarian regime. That's 87% of the world's population, almost 7 billion people. So for them, a sovereign savings account that's permissionless, meaning you don't have to have ID to use it, is a big, big deal. You know, close to 1.3 billion people who live under double or triple digit inflation. We're talking huge countries. Nigeria, 200 million people, 15% inflation. Turkey, 15% inflation for 100 million people. Argentina, 40% inflation for a country of 45 million people. So you can go down the list. There's about 35 countries where like people's earnings, their wages, are literally disappearing in front of their eyes over a matter of weeks or months against things like the dollar or gold or real estate, right? So this is a huge issue. It absolutely is a human rights issue for me. I mean, when it comes to your time and energy, having control over that or having it stolen from you, I think this is pretty clear. And Bitcoin is like an immediate, low cost, easily accessible solution for people.
So what I say is go tell the mother of 5 in El Salvador, as a result of Bitcoin, she now receives 20% extra remittance from her sister every year, because rather than that $50 per month being sent from her sister in the US to El Salvador and the Western Money Union taking $10 out every time, she now gets less than 1 cent taken out because it's transferred through the Lightning Network, and that's 20% more money for her to run that family. Try telling someone in Nigeria who's engaging in peaceful protest against an authoritarian regime and has just had all their assets frozen, but because they had Bitcoin is still able to run a campaign of protest against the government. Try telling someone in Argentina who's a bricklayer who is experiencing hyperinflation of 6.7% per month, who's just seen half of their life savings dwindle to nothing, which has been hard won over 10 years, that Bitcoin has no value, where now suddenly they have a store of value where they can preserve their family's wealth. So, and we're not talking isolated incidences. These are huge communities of people who don't have a proper functioning financial system, either because of hyperinflation or because the financial rails just were never put in place. And they, in many cases, don't have access to the same freedoms that we do: freedom of speech, freedom of movement, and financial freedom. And Bitcoin is providing absolute hope to them. So the use case for Bitcoin has actually been experienced in these countries which are outside the West first.
Yeah, I mean, and look at where it's getting adopted. It's like Latin America, West Africa, Southeast Asia, Eastern Europe. They're places that don't necessarily have the strongest respect for property rights. They might have a history of inflation. They might have a history of banking system that doesn't work or is used to plunder the savings of individuals. So it's all places where you have a reason to want to own your assets directly, outside of the control of either the state or the banking system. And it's not a coincidence that Ukraine was up there. Now, Ukrainians are relatively well positioned in terms of becoming refugees and asylum seekers and leaving their homes. Obviously, it's tragic that they have to do that, but leaving their homes with at least a portion of their savings intact because they can hold it on a hardware wallet or memorize 12 words. That's not really possible with gold, you know? So that is a new thing. And people are going to be shocked in the coming months with the amount of stories that come out from Ukrainians saying, yeah, like the only reason I was able to secure anything, any of my financial security, any of my assets, anything like that, was because I had a digital bearer asset.
Well, those stories are already coming out. I've seen them.
Yeah, exactly. I mean, and like having a digital bearer asset, something you can truly own that's outside the banking system because it's not working in Russia or Ukraine right now. The ATMs aren't working. The currencies themselves are failing. The banks don't work. You don't have time to, get your, affairs in order or anything like that. Cryptocurrency, Bitcoin, is working, right? It continues to work. And now not everyone was onboarded onto it, obviously. Only a small percentage of the population was. But for those that were, it's a lifesaver. It's a godsend. And so it is this bottom-up movement that is demonstrating real value in, relatively developed countries. This isn't in like the total third world or anything like that. So I don't know how you ignore that case study. We see a lot of sort of like Americans dismissing cryptocurrency and Bitcoin, saying it has no use. But how can you possibly look at what's happening in Eastern Europe and think to yourself, this thing is useless now? Because it's the last line of defense financially for a lot of these people that would have had no alternative otherwise.
Bitcoin is a global network of hundreds of thousands of computers called nodes. Each node maintains a copy of the ledger. This ledger is made up of segments called blocks that are filled with transactions that occurred over a 10-minute period and go back in a chain every 10 minutes back to 2009. Each block typically contains about 2,000 transactions. Some of the nodes, in addition to keeping a copy of the ledger, work to process the transactions of the network. These are called miners because they do a bunch of work and in return get rewarded with newly created Bitcoin. So how do miners process transactions? Let's say Eve wanted to send money to another account. This transaction is broadcast to the network and put into a pool of pending transactions. Every 10 minutes, one of the miners puts a few thousand transactions from this pool into a block and broadcasts that block to every node in the network. Each of these nodes then independently check to see that the transactions in the block are valid and following the rules. If so, they add the block to the end of their blockchain.
We can go to what's called a blockchain explorer or block explorer. And we can see here, I'll link to this in the description notes below, you have something called height. And we're currently, as I'm recording this, we're on block 641,172. That's how many blocks have been created and added to the blockchain since 2009. Now, if we just click on this top block, block number 641,172, I'm just going to open it in a new tab. We can see the number of transactions in it. There are about 3,231 transactions. You can see a whole bunch of other stuff that I'm not going to go into right here. But if we scroll all the way down, we can see the individual transactions that are included in this block. So here, for example, someone sent 31.0569 Bitcoin. And this goes on and on for, call it 10 pages. So this would be a single block like this new block right here that's being added to the blockchain as we speak.
will now allow anyone in the world to be a block creator. What that means is that they're going to listen for transactions being broadcast, collect them into some block, and then do a whole bunch of work to find a special number that makes the hash of that block start with 60 zeros. Then once they find it, they broadcast out the block that they found. To reward a block creator for all this work, when she puts together a block, we'll allow her to include a very special transaction at the top of it, in which she gets, say, 10 ledger dollars out of thin air. This is called the block reward, and it's an exception to our usual rules about whether or not to accept transactions. It doesn't come from anyone, so it doesn't have to be signed, and it also means that the total number of ledger dollars in our economy increases with each new block. From the miner's perspective, each block is kind of like a miniature lottery, where everyone is guessing numbers as fast as they can until one lucky individual finds a special number that makes the hash of the block start with many zeros, and they get the reward. Imagine someone shows you a list of transactions, and they say, hey, I found a special number so that when you put that number at the end of this list of transactions and apply SHA-256 to the entire thing, the first 30 bits of that output are all zeros. How hard do you think it was for them to find that number? Because SHA-256 is a cryptographic hash function, the only way to find a special number like that is just guessing and checking. This is called a proof of work. And importantly, all of this work is intrinsically tied to the list of transactions. If you change one of those transactions, even slightly, the resulting hash changes completely. The way the output changes as you slightly change that input is entirely unpredictable. So you'd have to go through another billion guesses to find a new proof of work, a new number that makes it so that the hash of the altered list together with this new number starts with 30 zeros. In the same way that a transaction is only considered valid when it's signed by the sender, a block is only considered valid if it has a proof of work. And also, to make sure that there's a standard order to these blocks, we'll make it so that a block has to contain the hash of the previous block at its header. That way, if you were to go back and change any one of the blocks, or to swap the order of two blocks, it would change the block that comes after it, which changes that block's hash, which changes the one that comes after it, and so on. That would require redoing all of the work, finding a new special number for each of these blocks that makes their hashes start with 60 zeros. Because blocks are chained together like this, instead of calling it a ledger, it's common to call it a blockchain. To see why this makes for a trustworthy system, and to understand at what point you should trust that a payment is legit, it's actually really helpful to walk through exactly what it would take to fool someone using this system. Maybe Alice is trying to fool Bob with a fraudulent block. Namely, she tries to send him one that includes her paying him 100 ledger dollars, but without broadcasting that block to the rest of the network. That way, everyone else still thinks that she has those 100 ledger dollars. To do this, she would have to find a valid proof of work before all of the other miners, each working on their own block. And that could definitely happen. Maybe Alice just happens to win this miniature lottery before everyone else. But Bob is still going to be hearing the broadcasts made by other miners. So to keep him believing this fraudulent block, Alice would have to do all of the work herself to keep adding blocks on this special fork in Bob's blockchain that's different from what he's hearing from the rest of the miners. Remember, as per the protocol, Bob always trusts the longest chain that he knows about. Alice might be able to keep this up for a few blocks if, just by chance, she happens to find blocks more quickly than the rest of the miners on the network all combined. But unless she has close to 50% of the computing resources among all of the miners, the probability becomes overwhelming that the blockchain that all of the other miners are working on grows faster than the single fraudulent blockchain that Alice is feeding to Bob. So, after enough time, Bob's just going to reject what he's hearing from Alice in favor of the longer chain that everyone else is working on. Notice, that means that you shouldn't necessarily trust a new block that you hear immediately. Instead, you should wait for several new blocks to be added on top of it. If you still haven't heard of any longer blockchains, you can trust that this block is part of the same chain that everyone else is using. So even though there's no central authority and everyone is maintaining their own copy of the blockchain, if everyone agrees to give preference to whichever blockchain has the most work put into it, we have a way to arrive at decentralized consensus.
Let us understand the role electricity plays in this system. Electricity comes at a cost, so the Bitcoin network must give something in return for this expense. Proof of work makes counterfeiting and record tampering extremely costly, just as expensive as making valid transactions. A malicious actor must use more energy on the task than the entire honest network combined. So when someone says, Bitcoin uses more energy than Switzerland, this would also mean that if Switzerland used all of its electricity supply to mess with Bitcoin's transactions, it wouldn't come close to changing anything. This security is necessary for a global, freely available, politically independent monetary system.
Earlier, I said that the proof of work might be to find a special number so that the hash of the block starts with 60 zeros. Well, the way the actual Bitcoin protocol works is to periodically change that number of zeros so that it should take, on average, 10 minutes to find a new block. So as there are more and more miners added to the network, the challenge actually gets harder and harder in such a way that this miniature lottery only has about one winner every 10 minutes. And all of the money in Bitcoin ultimately comes from some block reward. In the beginning, these rewards were 50 Bitcoin per block. But every 210,000 blocks, which is about every 4 years, that reward gets cut in half. So right now, the reward is 12.5 Bitcoin per block. And because this reward decreases geometrically over time, it means there will never be more than 21 million Bitcoin in existence.
Here's an example actually from Etsy of a sort of boutique Bitcoin miner. This just gives you an idea of what they look like. Normally you'll see these giant Bitcoin mining rigs or farms where you see many computers strung together. And these things are expensive. People have a lot of faith in the future of Bitcoin, especially Bitcoin miners, and they're willing to actually spend billions of dollars on mining equipment. And the key for Bitcoin miners is they just want to earn enough. They want to earn more from mining new Bitcoin than it costs them to set up these buildings with these specialized computers in them, to pay for all the utilities, to pay for the electricity, to pay for the cooling, etc. So we've talked about the blockchain, just a string of blocks. We've talked about the miners who create the new blocks. Now we're going to talk about the nodes. A node, especially a full node, is just a computer that's running the Bitcoin software. and that contains a complete copy of that entire blockchain. That's why it's called a full node, because it has the whole blockchain on there. Yeah, and you could basically do this on your laptop or desktop. You basically just go to the Bitcoin website, and you can just go here, you download Bitcoin Core, and it will basically start communicating with other computers on the network. They make sure that nothing is fishy. They verify all the transactions, and they make sure that the same address or the same person is not spending the same Bitcoin twice. And so the more nodes in the network, the more secure the network is, and the more real power is in the network. I'm going to show you a map right now. These are all the nodes around the world. When people talk about government shutting down Bitcoin, especially the United States shutting down Bitcoin, which it's certainly not going to do. It looks now like they're going to regulate it. But you can see there are all these nodes in North America, in Europe, in Russia as well, in China, in other parts of Asia, in India, in Australia, in South America, etc., in Africa. Just because the U.S. decided to maybe treat Bitcoin like marijuana and break into your house and make sure you don't have either of them, they wouldn't be able to do this to machines in China or Russia. They're not really going to put up with it, etc. So this is the real power of the Bitcoin network. It's completely decentralized. It's not controlled by anyone. It's basically all of these nodes talking to each other. And this is one reason that it's very difficult to come up with your own cryptocurrency or reinvent Bitcoin, maybe do a hard fork, as people have tried to do with some of the Bitcoin forks, is that you can do whatever you want. The Bitcoin software is open source. You can change it. But how do you convince all these people around the world to run your software? This is the real power of network effects, the power of having so many people invested in the Bitcoin network, both by running full nodes, as well as all these miners who have spent millions or even billions of dollars investing in Bitcoin mining.
As we know, a lot of different alternative currencies and alternative money forms were created in the 90s, in the early zeros. Unfortunately, though, they didn't work quite well because most of them were centralized, more often than not, of course. And when something is centralized, it is very easy to shut down. A privilege of creating and controlling your own money, let alone a monopoly on it, is something that gives sort of the controllers of that system a tremendous amount of power, arguably more than anything else in the world. With Bitcoin, proof of work, once again, coupled with several other things, allows the system to be secure and decentralized at scale, as well as allows us to timestamp transactions on the ledger in a sort of decentralized, trustless, or rather trust minimized manner, which allows Bitcoin for the first time to be an alternative monetary system and an alternative currency, which is several orders of magnitude much harder to shut down, to censor, to stop, and to manipulate than any other project of a similar variety that has ever arrived in the past.
So just maybe walk us through how you see the Bitcoin network as like a defense mechanism.
You know, you can abstract governments as effectively a trade mediation as a service, right? This is like, it gets back to like the champagne fairs in medieval Europe. You would need a military. You need a military to preserve trade routes, right? That's why you have Navy. Okay, the Navy will make sure that we don't, that our trade routes are uninterrupted. You need a rule of law, right, to preserve the rules of the contracts, to build the contracts, to preserve the rules of the contracts. And then you need a monetary entity as well. Bitcoin is all three. It is a military, it is a rule of law, and it is money. The miners, the mining network is its military. The nodes, right? And the software is the rule of law and the legislation and all the voting. And the least interesting part of it, in my opinion, is the money, the Satoshis, right? That's like the thing that comes last. What makes Bitcoin so special is that it has its own military that is literally as powerful as nation state militaries. All civilization, all living creatures obey the social consensus protocol that those who project the most kinetic power in the most clever way earn the right to set the state and chain of custody of limited resources. No one gets the option to like unsubscribe from this social consensus protocol, right? Those who project the most kinetic power set the state and chain of custody. The role of the military is to project so much kinetic power that it's too expensive not to cooperate with whoever owns that military, right? That's the main deal. Animals will actually grow random power projection mechanisms out of their foreheads so that they can continue to play the game and establish pecking order and to achieve consensus on the legitimate state and chain of custody of resources like territory, right? We call them antlers, right? We call them, look at bugs with their weird horns on the top, right? The cool thing about kinetic power projection is it's a permissionless protocol. I don't need the permission of another country or another person if I can project enough power in a clever way. Bitcoin takes the exact same game, right? But it transposes that game digitally. So instead of kinetic proof of work, you do electric proof of work. So let's just do a thought experiment.
I would love to do a thought experiment with you. Go ahead.
How many bombs would it take to blow up the internet?
A lot.
Yeah.
I don't know. Maybe you've thought about it. How many?
It would probably take a lot of bombs, right? Like to stop Bitcoin, you would have to hunt down every miner forever, right? And maintain that. And so that's like really difficult to do. The thing that bothers me about like these ESG accusations against Bitcoin is like they fundamentally misunderstand what the point of Bitcoin is, right? They fundamentally misunderstand what the point of all that energy or all that power projection is. The point of projecting that much power is to make it too expensive to attack the ledger, right? Like to make it too expensive to be uncooperative with the people who use Bitcoin. This is exactly what the military does, right? The power of every single bomb, the power of every single bullet, the power of every heartbeat of every service member of every military in the world is measured in watts. And those watts are spent explicitly to protect and defend resources. And to say that Bitcoin is a waste of energy is effectively the same as saying your military is a waste of energy. It's a waste of energy to have a standing military to protect our rule of law or whatever we're trying to protect. Like, yeah, it's inefficient to sail a bunch of carrier battle groups through the ocean, right? You know, it's more inefficient, Anthony, than sailing a bunch of carrier battle groups or testing about a bunch of nuclear missiles all the time. Being invaded, being conquered, that's pretty inefficient. The point of Bitcoin is to defend the network, to defend every user that volunteers to make that underlying piece of property their form of money.
Today, Bitcoin is 21 million total supply, right? That is what is written into the code. Detractors would argue that that can change through two different ways. One is if the miners all agreed to allow an increase in the total supply.
To answer your first question, miners aren't in control of Bitcoin.
Okay.
Full nodes, i.e., users are in control of Bitcoin, and the user activated soft fork is something that has essentially proved that. More than 93% of miners wanted to increase the block size in sort of their way. More than 85% of the companies, exchanges, wallet providers were on their side as well. Essentially, all of many of the wealthiest Bitcoiners were on their side. However, so the users and those people running full nodes, they decide what kind of code to run, and as well as what kind of transactions to approve. Miners cannot make these changes to the code without consensus. And at the end of the day, Bitcoin is this impenetrable fortress of full nodes, which really collectively, as we've previously discussed, in a P2P network fashion, control the network. And I strongly recommend Stop and Decrypt's article titled "Bitcoin is an Impenetrable Fortress" for more nuance on this topic.
What is so special about the governance of this digital currency?
The governance process of Bitcoin is what Pierre Rochard calls a P2P anarchic network governance. And technically, the governance has to do a lot sort of with the Bitcoin improvement processes and how those get proposed and how those get reviewed, how those get added in, etc. It's a very conservative, extremely meticulous process, which I consider a strength. A lot of people consider that, or a lot of people complain that Bitcoin is not evolving or Bitcoin is too slow. And to me, those people are sort of exhibiting high time preference and impatience. I think the altcoin boom and the ICO boom, a lot of the blockchain boom as well, has its origins in part because of this. True Bitcoiners understand that this isn't a 6-year get-rich-quick scheme, but it can be an 80-year project. And it's something that perhaps will continue going on until the end of our lives. And so every changes to the system need to be extremely, extremely careful. And the fact that it is slow to change is something that really makes Bitcoin far, far stronger than everything else. And the number one reason, and I can give dozens of reasons, but the number one reason why altcoins are far, far behind Bitcoin is precisely because they are much more centralized in relative terms, and everything about it is much easier to change. And currencies, first and foremost, are all about trust. As I like to repeatedly say, these crypto assets are, unlike many people sort of in the VC world, San Francisco, California, they think of these things as software platforms. They try to apply the late zeros, early 10 sort of tech paradigms to this thing. But really, to me, it's a monetary phenomenon. In very loose terms, I like to describe these things as digital monetary metals. To me, that's sort of arguably the closest metaphor for now. I like to even say that they aren't, Bitcoin being compared to digital gold is an understatement. And really what it is digital monetary nuclear weapons. Because if you really dig into the third and the fourth order game theoretic effects that are likely to arise when this thing gets just a little bit bigger, which to me it inevitably will, there's just so much that it is going to cause and reorganize in this world. Right now, some of the better currencies are the US dollar, euro, the Swiss franc, etc. But really, people use those because essentially they're picking the least bad thing. Unlike other currencies, which their respective central banks, in the case of fiat, can print essentially whenever they want, and as well as their sort of respective local commercial banks can create more of when issuing debt. Bitcoin is limited to strictly 21 million units. Some of them, it is believed that several million have already been lost. I believe that when all is said and done, the global supply of Bitcoin is going to be somewhere between 16 and 17 million. The fact that nobody can print beyond the 21 million limit, and the fact that the users, the miners, and essentially everybody in the developers, everybody who has as little as one Satoshi of Bitcoin, they are incentivized in having that rule be the number one and the most important sort of rule, and the number one focal point, the number one Schelling point, which the community is gathered around. And really, this is the number one thing which allows Bitcoin to continuously increase in value. And people are already pricing in its extreme scarcity. I like to say we've never had an object, let alone a money, as scarce as Bitcoin before. Even gold is expanding at a rate of around 1.6% per year over the last 10 years. Now, I believe that by the late 2020s, that number for Bitcoin is going to be lower than 1%. And it is every year it's getting lower and lower. And so I believe that soundness, that hardness of currency isn't palpably felt by people yet. And even a lot of participants in the market, a lot of sort of traders and investors, they don't really quite grasp this aspect yet. But I believe that this is the revolutionary thing here. And this is why I believe Bitcoin is going to be in the hundreds of trillions in today's terms in the future. And sort of this is my reasoning around this. Right now, it is believed that the total money supply of all fiat currencies around the world is somewhere around $80 trillion. Mm-hmm. If you consider M1, M2, M3, if you add them all up around the world. And I strongly believe that number is artificially diluted and artificially kept small, because essentially by continuously printing, governments are disincentivizing the world and disincentivizing investors and even average people to store too much money in currencies. Because the current fiat currencies are inflationary, a lot of high net worth individuals and asset managers around the world use the stock market, use the fixed income markets, use the real estate markets as a store of value. That is part of the reason why if you try to buy an apartment in Tokyo, London, or New York, the prices are insane. And this is because both American high net worth individuals and foreign high net worth individuals use these sort of prime city luxury apartments as one of their stores of value. Because the money is constantly getting diluted, people like surgeons, artisans, dentists, etc., engineers, they either have to play part-time investors on the side, or they have to sort of outsource those services to registered investment advisors and brokers, etc. And that's part of the reason why the financial system is much bigger than it has to be, and why Wall Street is just a ginormous part of the world's economy. Because the fiat currencies are constantly diluted, at the same time, this has caused an artificial sort of increase in the value of other asset classes and other financial instruments as people are hunting for yield. The aggressive sort of quantitative easing and the aggressive sort of unorthodox negative interest rate monetary policies of some central banks since the financial crisis have exacerbated this effect even further.
We had 500, 600 million in cash, and we were buying our stock back a bit. And then we were thinking maybe we'll need to buy another company. We need it for a rainy day, or maybe something really bad will happen and we'll really need the money. And it wasn't that long ago that the risk-free interest rate was 5% before the great financial crisis. And I'm like, well, I'm going to make $25, $30 million a year on this. And I kept hoping and waiting for those good times to come back. I was the guy that when the interest rates, when the 30-year T-bill interest rates started to go to 3.5%, I'm like, finally they're going to go to 4, and then they're going to 5, and they're going to go back to normal, right? Normal interest rates. And then, of course, hope was dashed. It went the other way. I didn't really think about it until I got slugged in the face with the 2x4, which kind of happened around March or April, when Main Street shut down, the economy shut down, and bonds went through the roof. When municipal bonds went up while every city is bankrupt, when Apple stock and every other public tech equity went up, and the multiples blew out, and the economy went to the worst place I've seen in 30 years, at that point you start having a thought with yourself, which is, what is the true inflation rate? And now, what does that mean to me metaphorically? Well, here's how I feel. I felt like I had $500 million of cash in the bank, safe, and it was yielding 2-3%, and I'm ready for a rainy day, and then I'm starting to do stuff with it. And then every month, some banker sends me a note saying the interest went down. It went down. Now there is no interest. And then someone took my cash out of the bank and they put it in the backyard in pallets. And then they opened my back gate. And then every month, someone comes along and starts burning 2% of the money. And then I started thinking, well, in 12 months, 25% of the money is going to be gone. And then, then I started thinking, what is the point of all this? What am I doing wrong? And of course, the answer is you can't hold cash. And so what do you do with it, right? There's 3,500 publicly traded companies. There's $5 trillion in their treasuries, and it's all melting. And yeah, at some point, you have a fiduciary obligation to not lose the money. Okay? Like it used to be acceptable to be conservative, but that was before the asset inflation rate went from 6% to 30%. When the inflation rate goes to 30%, it's not necessarily something you can ignore. There's something like $200 trillion worth of debt instruments and other treasury instruments that have a negative real yield. And precious metal is just one of them. So if you're looking at $10 trillion in gold, there's easily $100 trillion of, what is this, shadow money, 75 trillion of that, 75 trillion of sovereign debt, 50 trillion of other stuff. So you're really looking at 200 trillion or more of negative real yield. The only debate is how negative it is. And Bitcoin is the only thing I could find that's positive. If you actually talk to economists or you look at the economy and you ask the question, how fast does the economy grow in its entirety year over year? Generally about 2 to 3%. Like the sum total impact of all this technology and human ingenuity might get you a 2.5–3% improvement a year. If you look at the S&P index, which is a market basket of scarce desirable stocks, on average, it looks like it returned about 10%. So if you look at what's going on, really, when you're holding $1 million of stocks and you're getting a 10% gain a year, you really get a 7% expansion of the money supply. You're getting a 2 or 3% gain under best circumstances. And another way to say that is, if the money supply stopped expanding at 7% a year, the S&P yield might be 3% and not 10%. It probably should be.
Would my house go up in value without $185 trillion of stimulus over the last 20 years? The answer is simply no. Houses would go down in value or stay constant. The value has gone up because you're destroying monetary value, and assets are trying to hold some of that value as you're monetizing into that.
Weed is up, oil is up, everything is up, gold is up.
Yeah, you kind of don't want commodities to be stores of value.
No.
Because we need them. It's kind of like why it's bad for property to be a store of value, property, because you need to live in it, and so it makes it more expensive.
What's the problem with the inflation rate in housing being 19%? It's an awful problem for a 22-year-old that's starting their first job, that's saving money to buy a house. But it would be characterized as a benefit to society by a conventional economist who would say, well, housing asset values are higher because of interest rate fluctuation, and now the economy's got more wealth. And so that's viewed as a benefit. A conventional view of inflation as CPI understates the human misery that's inflicted upon the working class. What if I told you that the ship leaked 2% a year? That means you have a useful life of, its half-life of 35 years. That's basically the half-life of money in gold. If I store your life force in gold, under perfect circumstances, you have a useful life of 35 years. But the tragic notion is the money has had a half-life of 10 years. In weak societies, in Argentina or the like, the half-life of the money is 3 to 4 years. In Venezuela, 1 year. So it's a massive shift of wealth from the working class to the propertied class. It's a massive shift of power from the free market to the centrally governed or the controlled market. It's a massive shift of power from the people to the government.
Since 1973, the US dollar has had a monopoly on oil pricing, effectively. We've had the most important resource, the master resource really, is energy. And there's been a monopoly on energy, and it's been enforced with financial sanctions, geopolitical wrangling, at times violence. But it's been a system that worked. And so some people say, well, this has been a bad system, or it's an unjust. We need to go back in time and understand why this system evolved. So if we go back to at the end of World War II, at Bretton Woods, there were two options. There was John Maynard Keynes proposed something called the Bancor, which was a neutral settlement asset that floated in all currencies and would have basically prevented systemic deficits and surpluses from building up over time that we have since seen, because we didn't go with the Bancor. We went with a proposal from the United States as voiced by Harry Dexter White, which was the dollar is the center of the system. The dollar's pegged to gold at $35 an ounce, and everything else is then tied to the dollar. That system worked at first. It came under stress because of the dollar peg and the U.S.'s spending in Vietnam. And by 1971, it was clear to everybody that everybody knew the U.S. owed way more money than it could satisfy with the gold we had. And so our choices were, number one, devalue the dollar significantly against gold to basically take that gold backing up to a level requisite to reestablish confidence in the dollar and in the Bretton Woods system, or close the gold window, default on the whole system, and move to something else. And we chose the latter. So now you have a global reserve currency, the dollar, with effectively no backing. And so then we moved to this petrodollar system, where what we effectively did was replace the gold backing of the dollar with oil backing.
For example, in the 1970s, there were various deals set up between the United States and Saudi Arabia and other OPEC nations to make it so that they only price their oil in dollars. So regardless of who buys it, if France buys it, if Japan buys it, whoever buys oil that has, basically has to import it from the Middle East and other countries, they have to do so in dollars, which means every country in the world that is not energy self-sufficient needs dollars. So they either can exchange their currency to get dollars, or they can start selling their goods and services in dollars as well. And so most countries, when their currency gets too overvalued, their exports become uncompetitive and they have a recession. And then, the markets eventually kind of sort that out. The United States is unique because even when we have a currency devaluation, it's never significant enough to get us all the way back to the baseline. In order to maintain global currency, reserve status as currently structured, we basically have to run perpetual trade deficits. So unlike just about every other country in the world, we've run like 50 years of almost nonstop trade deficits. And so we just, we've basically exported our supply chains, our industrial base, our manufacturing base to international countries to a much greater extent than other developed countries have. And that supplies the rest of the world with dollars. And those countries then take those dollars and it filters up to the central banks and the sovereign wealth funds, and then they reinvest those dollars. And a lot of that goes back into U.S. markets. And so they buy our bonds, they buy our stocks, they buy our real estate. This has been a very strong period of performance for U.S. assets, somewhat at the cost of say, the U.S. industrial base and the U.S. blue-collar workers. So we've kind of running this big engine of trade deficits to get recycled back into our capital markets, which are very good for those of us that own assets.
Productivity versus compensation. Remember I said that second regime ended in the 70s? Boom. All the way in that first regime, what you have is productivity and wages going together exactly as I described, which peaks, as I'll show you in a minute, in 1973. So hourly compensation stagnates, but productivity goes up. That gap is just another way of measuring the inequality gap, because that's the returns to capital, that's the returns to labor.
Three main forces that drive the economy. Number one, productivity growth. Number two, the short-term debt cycle. And number three, the long-term debt cycle. We'll look at these three forces and how laying them on top of each other creates a good template for tracking economic movements and figuring out what's happening now. Let's start with the simplest part of the economy, transactions. An economy is simply the sum of the transactions that make it up, and a transaction is a very simple thing. You make transactions all the time. Every time you buy something, you create a transaction. Each transaction consists of a buyer exchanging money or credit with a seller for goods, services, or financial assets. Credit spends just like money, so adding together the money spent and the amount of credit spent, you could know the total spending. The total amount of spending drives the economy. People, businesses, banks, and governments all engage in transactions the way I just described, exchanging money and credit for goods, services, and financial assets. The biggest buyer and seller is the government, which consists of two important parts: a central government that collects taxes and spends money, and a central bank, which is different from other buyers and sellers because it controls the amount of money and credit in the economy. It does this by influencing interest rates and printing new money. For these reasons, as we'll see, the central bank is an important player in the flow of credit. Most of what people call money is actually credit. The total amount of credit in the United States is about $50 trillion, and the total amount of money is only about $3 trillion. So why is credit so important? Because when a borrower receives credit, he is able to increase his spending. And remember, spending drives the economy. This is because one person's spending is another person's income. Think about it. Every dollar you spend, someone else earns, and every dollar you earn, someone else has spent. So when you spend more, someone else earns more. When someone's income rises, it makes lenders more willing to lend him money because now he's more worthy of credit. So increased income allows increased borrowing, which allows increased spending. And since one person's spending is another person's income, this leads to more increased borrowing, and so on. This self-reinforcing pattern leads to economic growth and is why we have cycles. Suppose you earn $100,000 a year and have no debt. You are creditworthy enough to borrow $10,000, say on a credit card. So you can spend $110,000 even though you only earn $100,000. Since your spending is another person's income, someone is earning $110,000. The person earning $110,000 with no debt can borrow $11,000, so he can spend $121,000, even though he has only earned $110,000. His spending is another person's income, and by following the transactions, we can begin to see how this process works in a self-reinforcing pattern. But remember, borrowing creates cycles, and if the cycle goes up, it eventually needs to come down. This leads us into the short-term debt cycle. As economic activity increases, we see an expansion, the first phase of the short-term debt cycle. Spending continues to increase and prices start to rise. This happens because the increase in spending is fueled by credit, which can be created instantly out of thin air. When the amount of spending and incomes grow faster than the production of goods, prices rise. When prices rise, We call this inflation. The central bank doesn't want too much inflation because it causes problems. Seeing prices rise, it raises interest rates. With higher interest rates, fewer people can afford to borrow money, and the cost of existing debts rises. Think about this as the monthly payments on your credit card going up. Because people borrow less and have higher debt repayments, they have less money left over to spend, so spending slows. And since one person's spending is another person's income, incomes drop, and so on and so forth. When people spend less, prices go down. We call this deflation. Economic activity decreases, and we have a recession. If the recession becomes too severe and inflation is no longer a problem, the central bank will lower interest rates to cause everything to pick up again. With low interest rates, debt repayments are reduced and borrowing and spending pick up, and we see another expansion. When credit is easily available, there's an economic expansion. When credit isn't easily available, there's a recession. And note that this cycle is controlled primarily by the central bank. The short-term debt cycle typically lasts 5 to 8 years and happens over and over again for decades. But notice that the bottom and top of each cycle finish with more growth than the previous cycle and with more debt.
In a perfect world, you deleverage all the bad debt, have the dust settle, and then go on to the next cycle. But because of the incentives that we live in, obviously policymakers want to come in and they want to shorten that cycle, soften that deleveraging cycle. And so they cut interest rates, they do fiscal stimulus. If you look at, say, debt as a percentage of GDP over time, let's say in the corporate sector, you only partially deleverage. So you don't go back to the leverage you had in the beginning of that cycle as a percentage of GDP. You only partially deleverage, and then you start building up from there. And so when you string multiple of those cycles together, you get higher highs and higher lows in debt levels, and then you get lower highs and lower lows in interest rates. And so you string those together for a couple decades or a few decades, and you go all the way down to zero interest rates and extremely high debt levels, and then you're trapped.
So this chart shows business cycles over the past 40 years. Over the decades, corporate debt decreases during recessions, but keeps making higher lows and higher highs. Interest rates lower in each cycle causes this increased debt buildup. Federal debt tends to run opposite to this trend, increasing swiftly during recessions due to falling tax revenues and increased federal spending. In other words, when the private businesses default on debt, the government accumulates more debt. And so we have a string of short-term business cycles building up public and private debt over decades, leading to something much bigger, a long-term debt cycle.
Despite people becoming more indebted, lenders even more freely extend credit. Over decades, debt burdens slowly increase, creating larger and larger debt repayments. At some point, debt repayments start growing faster than incomes, forcing people to cut back on their spending. And since one person's spending is another person's income, incomes begin to go down, which makes people less creditworthy, causing borrowing to go down. Debt repayments continue to rise, which makes spending drop even further, and the cycle reverses itself. This is the long-term debt peak. Debt burdens have simply become too big. For the United States, Europe, and much of the rest of the world, this happened in 2008. It happened for the same reason it happened in Japan in 1989 and in the United States back in 1929. Now the economy begins deleveraging. In a deleveraging, people cut spending, incomes fall, credit disappears, asset prices drop, banks get squeezed, the stock market crashes, social tensions rise, and the whole thing starts to feed on itself the other way. Less spending, less income, less wealth, less credit, less borrowing, and so on. It's a vicious cycle. This appears similar to a recession, but the difference here is that interest rates can't be lowered to save the day. In a recession, lowering interest rates works to stimulate borrowing. However, in a deleveraging, lowering interest rates doesn't work because interest rates are already low and soon hit 0%, so the stimulation ends. Interest rates in the United States hit 0% during the deleveraging of the 1930s and again in 2008. Remember, most of what people thought was money was actually credit. So when credit disappears, people don't have enough money. People are desperate for money, and you remember who can print money? The central bank can. Having already lowered its interest rates to nearly zero, it's forced to print money. $1 of spending paid for with money has the same effect on price as $1 of spending paid for with credit. By printing money, the central bank can make up for the disappearance of credit with an increase in the amount of money. In order to turn things around, the central bank needs to not only pump up income growth, but get the rate of income growth higher than the rate of interest on the accumulated debt. So what do I mean by that? Basically, income needs to grow faster than debt grows. For example, let's assume that a country going through a deleveraging has a debt-to-income ratio of 100%. That means that the amount of debt it has is the same as the amount of income the entire country makes in a year. Now think about the interest rate on that debt. Let's say it's 2%. If debt is growing at 2% because of that interest rate, and income is only growing at around 1%, you will never reduce the debt burden. You need to print enough money to get the rate of income growth above the rate of interest.
Because how do you get out of a debt crisis when you've generated a huge amount of debt? Whoops. And that is a huge amount of debt. Well, what you're meant to do is something called financial repression. And how do you do that? It's a weird term, but basically what it means is you're going to inflate your debt away.
Over the past 200 years, 51 out of 52 countries that got over 130% sovereign debt to GDP, in some way or another, did not pay that back in purchasing power terms. So either they default, which is common in countries where it's denominated in a currency that they can't print, like Argentina with dollar-based debts, or they restructure it, which is another. It's like a more polite default, or they pay it back, but it's inflated, right? So they have a higher rate of inflation than their interest rates for several years. Some cases hyperinflation, but more commonly just some degree of inflation. And a really good example is so United States history. We've only had one period in history where we had federal debt to GDP as high as it is now, and that was in the 1940s to fight World War II. And because sovereign debt was so high, so federal government debt was over 100% of GDP, when you started to see inflation, they couldn't raise rates because it would render the U.S. government insolvent, because when you have 100% debt to GDP and you're running 20% deficits, you can't have high interest rates on that. And so they just said, no, we're going to lock yields at 2.5% or less, and we're going to buy any treasury we need to in order to maintain that peg. So you had inflation going to the double digits, even as interest rates stayed at 2.5%. And so anyone holding cash or treasuries, you got all your money back nominally. No one defaulted on you if you were holding that safe paper, but you lost purchasing power compared to commodities. So by the end of that decade, you could buy fewer goods, you could buy, less house, less commodities with those treasuries. And that's historically what happens at the end of a long-term debt cycle, is that you inflate a lot of that debt away so that nominal GDP ends up kind of catching up to that debt rather than that debt ever being paid back in real terms.
This is what we did after World War II in this country. Within 10 years, a third of our debt after World War II was gone. Nobody even noticed. It's defaulting by inflation.
In the system we're describing, you cannot store your surplus wealth in the debt of another when that debt is just being created. Particularly in the aftermath of 2008, you saw the central banks move first when they started buying gold again for the first time in 35 years. And then in 3Q14, they stopped buying treasuries altogether, but they kept buying gold, and they keep buying gold. And so post 2008, because the financial system had become such a big part of GDP, because we'd become so financially levered, because the derivative markets were so ridiculously large, hundreds of trillions of dollars, if not quadrillions, it basically forced the Fed to do what they had to do. They had to save the system. They had to print whatever it took to save the system. But again, the flip side to that decision was this recognition that, as you put it, the U.S. was no longer could no longer manage the dollar as a public utility, as something that is a store, managed to be as good as gold for oil as it had been, from 1973 to 2003. And so the cracks emerged 03 to 08. 08 was when it was announced. That's it. Where push comes to shove, the Americans will take care of the Americans first, which means they'll print whatever they need to print to cover their deficits. And that, I think, was a wake-up moment. In the immediate aftermath of the 08 crisis, the head of the PBOC wrote a white paper at the BIS. He said, listen, we need a new global currency system. And he specifically cited Keynes's Bancor from the Bretton Woods conference, saying the fact that the choice we made at Bretton Woods has worked so poorly is a sign maybe we should have chosen that one. There's some merit to it. And they talked about the Chinese talked about a neutral reserve asset. The IMF and the World Bank in the intervening years of 2010, 2011 made references to that. 2014, the World Bank again. It naturally begins to push people back toward the market solution, which is you need a neutral settlement asset. You need a Bancor.
Generally, any country, when they get over a certain debt amount as a percentage of GDP, the central bank becomes the major buyer of their government debt. And the United States is no different in this case because foreigners have dried up their purchases to some extent.
Right, okay.
And so with China, they've been more specific about it, where they said, okay, instead of buying treasuries, we're going to start using our dollars to make loans to different countries around the world, help build out infrastructure to help cement China's, hub, basically as a big trade partner along Eurasia and into Africa and, around pretty much the whole world, essentially. And also to secure commodities. So they'll invest in commodity projects around the world that they have rights to. And so they're essentially taking dollars and putting them into various types of hard assets, and basically doing kind of that, almost that type of financial colonialism that the United States and the United Kingdom have done in the past. They're doing a similar approach now. And so they're kind of rising to that superpower status, despite the fact that their GDP per capita is still kind of in that middle income trap. And so to the extent that that continues working with them, and they have a lot of clout because they're such a large trading partner with most of the world, right? So over the past 20 years, the United States used to be the biggest trading partner with most countries, and that's shifted more and more towards China, where the majority of countries, their individual biggest trading partner is China. And so the fact that they have all those pieces together gives them a pretty significant shot at being able to de-dollarize their payment systems. And we're seeing early signs of it. So a lot of it's centered around Russia, in the sense that Russia trades with Europe, China, and India, and some other countries now, either completely or partially outside of a dollar-based system. That can include euros. So you can have an interesting thing where Russia and China trade using euros. You can also have their local currencies, like Russia and India. They can use their local currencies to do payments. And there's, depending on the country that they have clout with, if it's a very small nation and that they're very reliant on trade with China, China has a better probability of getting them to use that. Whereas maybe Russia says, we'll use a little bit of that, but we also want to use euros, or we also want to use rubles, for example, because they have some clout as well. So it really depends on the individual countries in question. And people often think that a reserve currency has to be binary. Like you either have the reserve currency, you don't, whereas in reality, it's somewhat of a spectrum. So the United States has, quote unquote, the reserve currency. It's very dominant, but the euro and the yuan are also these contenders where they're not really in a position to just replace the dollar and become the new kind of, just by far dominant global currency. But really what they're aiming for is to be regional reserve currencies. They want to be able to trade with enough of their partners for key things they need in their currency. They don't want another country to be able to cut them off from buying commodities and trading with their partners. And now, of course, the headlines are the CBDCs, where they basically can have programmable money and they can trade with some of their trading partners outside of the SWIFT system. using, I don't know what blockchain it was, but they were using blockchains to basically do purchases of like iron from foreign producers of it, where they say, okay, if you want to buy our technology, they make a lot of equipment. They say, okay, you buy it with these CBDCs. So we'll buy commodities from you using the CBDC, and then you can use those to buy our technologies.
With no need for internet or credit card, you can pay with a simple touch on your smartphone in the future in China. On August 14th, China's Ministry of Commerce issued a statement that People's Bank of China, the central bank, would test its digital currency in 4 areas in the country. The digital currency has exactly the same functions and properties as paper money, except that its form is completely digital. Simply put, China's central bank digital currency is the digitalized Chinese currency, China Yuan. The People's Bank of China began researching digital currency since 2014. China's CBDC is different from other digital currencies, such as Bitcoin, for the latter is not backed by government edict and has no legal tender status. CBDC, on the other hand, is government-backed and with unlimited legal tender status. For example, there is no legal problem if an institution or individual doesn't accept Alipay and WeChat Pay, but they would be against the law to refuse physical money or CBDC. Why China launches CBDC? It helps government to accurately manage and properly regulate the social wealth. It improves financial management of enterprises by increasing their work efficiency. CBDC satisfies the need for anonymous payment, while keeps traceable and monitorable when involved in crimes, such as money laundering, tax evasion, or gambling. There is no timetable for the launch of CBDC, but if everything goes well, we can hopefully try it out in 2022, when the Beijing Winter Olympics will be held.
There's been a huge amount of activity in the central banking community in researching and developing central bank digital currencies. It seems like almost every day there's a new announcement. As everyone knows, Sweden, the European Central Bank, and many other central banks are in the course of developing CBDCs, and China is pretty much ready. About 10% of people in China have used a wallet to hold ECNY. I think initially China wanted to do this to make sure that it didn't get too much invaded by undesired cryptocurrencies. And the Bank of Canada has set aside the same reason for developing a CBDC. There's a completely unrelated reason to get busy on this immediately. And that's the fact that you could be subjected to dollarization or yuanization, whether by a foreign CBDC or by a foreign stablecoin, more likely by a foreign stablecoin. And you want to get people using your own digital currency before someone else's digital currency invades your monetary sovereignty. That's one of the key reasons that's given in the Monetary Authority of Singapore report that came out today.
As digital assets become more common in the global marketplace, with the total digital asset market reaching almost $3 trillion, as Ranking Member McHenry just said, how do we ensure the U.S. dollar remains the reserve currency?
Well, Mr. Lukemeyer, it's terrific to see you again, and I'd give you a couple of thoughts on that important question. One is, if we start with stable coins before we talk about other crypto assets, I've said for a long time that the secular reduction in dollar holdings as a percentage of global central bank holdings is alarming. And this has been going on for more than 10 years at this point. So dollars as a share of the European Central Bank, the Japanese Central Bank, et cetera, has shrunk from 80+% to more like 60+% in a short amount of time. What that tells me is that in the future, with the rise of China and other major economies, the US dollar can't take its primacy for granted, and we need to start thinking about competing on utility, on features, not just based on a post-World War II monetary system that we could take for granted for the last 2 generations. And that's one of the reasons that I've been such a supporter of internet-enabled dollars, which allow us to compete on features, not only on history. I think that's really critically important. The second thing I would tell you is, as we enter year 11 or 12 of a highly inflationary environment, after all, we've been printing enormous numbers of new dollars since the financial crisis, there will come a time, gradually then suddenly, when the attractiveness of the dollar relative to other currencies could change. One of the benefits of the crypto economy is that it creates some counter incentives on the part of the Fed to do that kind of policy because people will flee to other kinds of assets. And that sort of market competition is something that I think will ultimately shore up our monetary policy and keep the dollar where it rightfully ought to be, which is as the dominant reserve currency it's been for all of our lives.
Exchanges today are adopting something called Lightning Network, which is a way to scale Bitcoin on a second layer. Much like we had gold bars, which we scaled with paper money, and then we had Visa credit cards, which were a way of scaling the paper notes. Bitcoin scales through Lightning Network. It's a private, instant, globally final settlement network. It's something you all should check out. It's very, very interesting.
The Bitcoin blockchain is used as a final settlement system, like Fedwire, not as a payment system like Visa or PayPal. The energy expanded delivers the final settlement without the need for a centralized party. Most Bitcoin transactions happen outside the main blockchain, on cryptocurrency exchanges, the Lightning Network, and retail payment systems. These are all considered second-layer payment options on top of the actual Bitcoin blockchain. From time to time, the second-layer payment systems will go to final settlement on the blockchain. It's easier for a monetary network to separate retail transactions from heavier settlement transactions. Our current financial system uses the same layered technique.
And so the US tortilla chip wants to send this raisin to the El Salvador tortilla chip. But you got all these tortilla chips in the middle. These are the required intermediaries to facilitate this money moving all the way from one closed loop regional system in the United States to El Salvador. Okay? And all these intermediaries in the middle, they have all these raisins on them, all these sunken costs. They got to pay all the rent for all the brick and mortar locations all over the world. They got to pay the SWIFT fees, the banking fees. They have to custody their own raisins so that in the event that you wanted to get a raisin in El Salvador, they had to front the credit to the next correspondent bank, and there's settlement delays, and there's cost of managing all their raisins, right? We can still allow the tortilla chips to interface with the raisins, and we just use the peanut to get rid of all the muck in the middle up above. The peanut does the job of SWIFT plus correspondent banking plus Western Union plus TransferWise. You don't got to touch the peanut. You don't got to deal with Bitcoin's volatility or the tax consequences or the accounting headache or how technical it is, and you don't got to be a cryptographer. We can use the peanut to escrow raisins between all the tortilla chips without having to deal with all the muck. And so here's a demo of me doing exactly that. This is me sending an international money transfer over Twitter from the US to El Salvador. Yo, we're here in Chicago. And we've got David here in a Starbucks in El Salvador. David has his Strike account linked to his Twitter account, and we're going to make a free, instant cash final remittance payment over Twitter. So I'm going to go search David's Twitter account on my phone. I'm going to find his tips button, and I'm going to send David $10 over Twitter for changing the world. It's going to open my non-custodial Lightning Moon wallet. Anyone in the world can download, and I'm just going to hit send. And boom. We just made an instant free remittance payment from Chicago, Illinois, USA to San Salvador, El Salvador over Twitter. Now this is David, the real David. David received his remitting payment over Twitter and immediately in San Salvador, El Salvador, checked out over the peanut standard at Starbucks. So let me just spell this out in plain English. $10 US were sitting here in Chicago, and they became a good or service at a local business in a different country in less than 60 seconds. That is remarkable. Okay, I'm not talking about making cross-border payments cheaper or faster. I'm talking about changing everything. Okay?
Queda aprobada la ley de Bitcoin.
Lawmakers in El Salvador broke into applause after voting to approve Bitcoin as legal tender on Wednesday, making the Central American country the first in the world to fully adopt the cryptocurrency. Congress approved the bill by a supermajority despite concerns the move could complicate talks with the International Monetary Fund, from which El Salvador is seeking more than $1 billion in financial support.
Bitcoin isn't competing against Venmo. It's not competing against PayPal or Visa. Bitcoin is competing against central banks, or even more precisely, it's competing against the Bank of International Settlements as a major settlement network for large transactions, as well as against central banks for currency issuance.
What did the internet do to the communications industry? It dematerialized it. What I mean by that is it took the value in these local, bifurcated, closed communication networks, and it leaked all onto one standard, one network. All that value came onto one. And then the winners on top of the new standard were those that developed the best experience. Whereas before, that's not true. It was really hard to compete with the local newspaper. They already had distribution and the licensing and all the fixed costs that had them build the factories. Like the Chicago Tribune building in Chicago is one of the biggest buildings ever, right? Like they had, right? But then all of a sudden, that wasn't what it was about. It wasn't about who got there first. It wasn't about who had the licensing. It wasn't about who had the distribution and who had the lobbyists in Washington, D.C. It was about who built a better consumer experience, which is amazing for the world. Because now business is optimized around you and I and our experience. I'm going to build something that allows people to publish communication on the web. And people are going to prefer to sit in their couch and read the news instead of go to your physical branch and pick up a newspaper. I'm saying the same is going to happen for money. Now we have an open global standard for money where anyone can compete. And it's better than all the legacy monetary networks. And the quality of everyone's life has a lot to gain by if we pop the bubbles of these closed networks and let them spill out onto Lightning and let the free market in the world build amazing experiences to pick it all up. And whether you want to interface that over dollars, over Starbucks points, or use Bitcoin, the native asset within the network, is up to you. There's no better way to escrow and settle value, period. Any monetary network in the world. It is the best monetary network at allowing for physical cash finality globally, period.
Bitcoin was unknown 12 years ago, and today 100 million people worldwide own Bitcoin. So just extrapolate that. What is the level of penetration you think we'll get? 500 million, a billion? You know, you can easily tune these adoption curves however you like. I don't think it's done, monetizing and being adopted globally.
Digital assets may be relatively new, but they're part of a larger trend, the digitization of finance, that's been in the making for decades. In 1990, there were fewer than 3 million internet users, and now there are about 4.5 billion. And we take for granted that many aspects of our financial lives can be managed from small internet-connected devices that fit into the palms of our hands. Financial services, along with most industries, have evolved in response to exponential advances in computing power and connectivity. Most recently, new technology has raised the possibility of reduced reliance on centralized intermediaries like banks and credit card companies. In 2008, a person or group of people using the pseudonym Satoshi Nakamoto proposed a decentralized peer-to-peer system for making and processing payments.
Elizabeth Warren is worried that Bitcoin mining uses too much energy. She should be worried that it uses too little. We have to electrify everything. Internal combustion engine in your car, oil heaters, right? Gas water heaters, gas heating in your home. All of that stuff has to stop. It has to be shifted to electrical power. International Energy Association says, once we're going to need to triple to quadruple our electricity production when we electrify everything, okay? And then IEA says, in order for that to work with renewables as the bulk of power production, we need to multiply our flexible load, it's called, flexible load on the grid by 10-fold in order for that to function, right? Because wind power is only there when the wind's blowing, solar power is only there when the sun is shining. How do we solve the problem of robustness? Because renewables are intermittent. We overbuild so that we don't run into energy scarcity. How do we incentivize a massive overbuild of our power infrastructure? How do we make that massive overbuild so that it's robust? How do we make that pay? Because there isn't demand for that much power.
Where you've got, 30, 35 gigawatts of load on a sunny, windy day, and only 5 gigawatts of local demand, and only 12 gigawatts of long-term transmission to the rest of the state. So you can't even really export all the energy. So then the energy asset owners can't sell it.
Then as that solar provider, you've got to deal with some utility or with the grid itself where they actually have to pay you. So they pay a fee for not being able to take your energy. So that's bad. That's bad for profitability. And the utilities will pass on that burden onto the end consumers, people who pay for electricity, residential users. So it's really bad economically, but it's also bad because it makes grid operators and utilities more nervous about taking on renewable suppliers if they have to pay all these curtailment fees. And so as a result, they're less willing than they would be to take these new renewable suppliers onto the grid. And so it doesn't happen as fast as it should do.
So at that point, that's where Bitcoin miners come in. They say, we're going to put a mine next to this wind farm. Having a flexible load, you're going to hear about this a lot. It ensures that the demand side can turn down. They can curtail their usage at a time of grid scarcity. And that's why ERCOT has some of the most sophisticated programs in terms of making insurance products available for miners to sell to the grid effectively. So miners sell these products, which is basically the right for the grid operator to ask them to turn off, and the grid eagerly buys them because they have so much wind and solar, which means that you basically need to buy more insurance because you have less predictability in terms of your generation. And Bitcoin miners feature in that because they are the best source of flexible load because they can turn themselves down at short notice. They can stay off indefinitely. No other industrial entity can do that. If you look at other industrial sources of demand response, like cement factories or steel mills, they can't stay off indefinitely. They can only stay off for an hour or two at a time. They can't turn down rapidly. They can't turn back online rapidly. So they are, they're doing physical processes.
But if it's a Bitcoin miner, then you don't lose anything because you're halfway through. It's not a process. It's a random number search. And so if you can sometimes within seconds be able to switch off. And for a grid operator to have a customer that is that flexible is not only unusual, it's an exception of one.
And so having buyers of that energy ensures that these installations can go up and stay up. What you are doing is rescuing the economics of renewables that are stranded, and you're allowing a structural overpenetration of renewables on the grid. So the Texas case study is the right one to focus on because that is going to be taken out to the rest of the US and then the world at large.